Hello and welcome to my channels. My name's Charles de Lastic. I'm the Managing Director of Blue Bond Tax Planning. We've been helping people with their inheritance tax for more than 18 years and have helped hundreds of clients save thousands of pounds on their inheritance tax and estate planning. So today's video is around loan trusts. What is it? What is it used for? And why would you want to consider setting one up? Okay, so why would you want to set up a loan trust and how does it work? So we set up loan trusts as discretionary trusts with two elements. Now, we don't use the loan trusts that are provided by large insurance companies, generally speaking, because we want these trusts to be able to exist a full 120 years irrespective of the viability of any given insurance company. So we use a lawyer to set them up, and also at the same time we make sure that the powers of the trusts are as you would expect from a normal discretionary trust for the long term, and it allows the trust to maintain the full 120 years if required. So you make a small gift into the trust of £10, and that counts as a settlement into the trust, and the trust is registered. Okay, then you can make an unlimited loan to the trustees of the trust. So when I say unlimited, you could literally put £10 million in, and because it's not a gift to the trust, you are not limited as such. So then, because it's a loan, the loan is still inside the settler's estate because the money, the capital, is still owed to the settler, and one of the benefits of that, of course, is it can be withdrawn at any time. However, the main purpose is of any growth of the investment is immediately outside of the estate for inheritance tax. So somebody puts £1 million in it and gets 10 years, get 10% growth. That 10% growth would be outside of the estate, but their original capital lent to the trust can be withdrawn back for their own purposes at any time should they choose to do so. So what's it used for and how? So sometimes it's investors with large amounts of capital. So say you've got a person who's already gifted a full amount into a trust and still waiting for the 7-year period to expire before they can make another gift, but they don't want their inheritance tax problem to get any worse, so they gift maybe, I don't know, 325,000 into a loan trust, knowing that over the next 7 years that any growth on that investment would be outside of their estate, and then after the 7 years they withdraw the loan, leaving the growth in the trust to continue long term for their beneficiaries, which is outside of their estate, but now they've got the capital back, which they can now put and gift either directly to children, or they may want to put it into another trust. They may want to use the fund sometimes, during the time that they're holding the loan, to withdraw the money to maybe help their children or grandchildren with maybe education fees or purchases of properties or whatever. So it's extremely useful to allow the problem not to get any worse for inheritance tax, and all growth is outside of the estate while still retaining access to the capital. Now, obviously for us, we're saying to clients, well, look, by the time you're around 75, you've got to live 7 years to get that value out of your estate. So around that age, one should be looking to pull the money out of the loan trust and put it into either another trust or gift the money out directly to children, depending upon what the client wants. Another use is for single, widowed or divorced people. So married couples may, for instance, put 650,000 into a flexible reversionary trust, allowing that money to be outside of their estate after 7 years, but get the capital back in tranches should they require it. But for single, widowed or divorced people, their limit into that type of trust is only 325, and they may think they want more capital available to them in their later years. So they make their gift into a trust, and then they make a loan into a separate gift trust, knowing that after 7 years they'll pull the money out and then either gift it or put it into another flexible reversionary trust at the time. So the whole purpose of this is to say, okay, I can put money into a trust understanding that any growth is outside of my estate immediately. So you invest and your investment does extraordinarily well, and within 3 months you've made 15% return. That 15% is outside of your estate, but the original capital always remains inside of your estate. So by the age of about 75, you should be looking to dispose of that loan into other arrangements, depending upon your circumstances. So that's a loan trust. That's how it's used. Thanks for listening, and bye for now. Bye.